Good afternoon, everyone, and thank you for attending this session. So today we are delighted to present you some developments in EU tax regulations, focusing on the European Union's proposal for a directive on transfer pricing. This directive, if agreed upon, is set to come into force on the 1st of January 2025. So it's really a game changer as it brings in, for the first time, a harmonized set of transfer pricing rules and procedures across the European Union. So the background of this directive is that on the 12th of September last year, the European Commission introduced a new package of tax initiatives. So this package included two critical documents. So the first one is the so-called BFIT. So BFIT for Business in Europe Framework for Taxation. And this basically sets out new rules for determining the taxable base of multinational groups. The second document is the Transfer Pricing Directive proposal, our main focus today, introducing uniform legislation that will harmonize, streamline transfer pricing practices across the EU. Currently, what is the situation? So the situation that we have at the moment is that each member state has its own transfer pricing regulations, which are often based on the OECD transfer pricing guidelines, but always with some, always with some specificities. And these specificities, they result in a patchwork of rules, which cause some issues that the directive wants to tackle. The three primary objectives of the directive are the following. So the first one is to reduce compliance costs for the companies operating within the EU. Indeed, what we see is that multinational currently faces significant administrative costs to comply with various sets of rules. So the directive wants to improve this. The second objective is to increase tax certainty and reducing also litigation or double taxation. Indeed, what we see today is that there are still a lot of litigation cases or MAP cases across the EU. And one of the reasons is due to differences in transfer pricing legislation between member states. Different rules can lead to different outcomes, and so it may be that, for example, the same income is taxed twice, leading to double taxation, or is even not taxed at all. So the third objective is, and it's probably the most important for the European Commission, is preventing tax avoidance. So to reduce the opportunities for companies to use, or let's say abuse, transfer pricing rules for aggressive tax planning purposes. So these are the three primary objectives of the directive. Overall, the key objective is to, as we said, increase legal certainty and also improve dispute resolution mechanism to make the EU a more attractive place to do business. So this proposal, it's part of a broader trend that we can see where the European Commission is increasingly issuing tax directives requiring unanimous agreement among member states. So as you all know, probably, notable examples include the EU anti-tax avoidance directives and the DAC 6 mandatory reporting arrangements. So the transfer pricing directive is another step in this direction, aiming to harmonize, standardize the transfer pricing practices in the different member states. So despite its advantages, the directive has also its detractors. For example, we have the Swedish government that already said that it would prefer global solutions to over EU-level solutions, and the reason for that is that they fear that EU-level solution could maybe create some conflicts with third countries. So as we need unanimity in tax matters at the level of the EU, it remains to be seen if the directive will be implemented in its current form. So maybe how about the EU, how they got involved in the area of transfer pricing. So transfer pricing legislation is still at the moment the prerogative of the individual European member states. We have seen the European Commission trying to impose its own interpretation of the arm's length principle, and this by bringing a large number of high-profile stated cases. So in Luxembourg, you may be familiar with the Fiat case. Equally, we have also the Amazon and Apple cases on the ground. And in these cases, the European Commission has started to challenge the transfer pricing methodologies applied by these companies, this group, in their intragroup transactions. And so what has been the result of that? The result is that now the European Commission has largely been unsuccessful in its attempt to impose its own version of the arm's length principle. And as a result, what we are witnessing now is that the EU Commission is taking a more direct approach to influencing the other member states via this directive. So now let's dive straight into the content of the directive proposal. So incorporation of the arm's length principle into EU law. As you know, transfer pricing, it's a mechanism to determine the market price, so the arm's length price on related party transactions. Many tax authorities, they require this arm's length price to safeguard their tax base. Otherwise, the situation could be that taxpayers will tend to shift profits from high tax to low tax jurisdictions. So who is in charge of this principle internationally? So far, it's the Organization for Economic Cooperation and Development, so the OECD, that has taken the lead to try to have a harmonized set of rules with their transfer pricing guidelines that are periodically updated. So the directive, the proposal, it essentially endorses the OECD's arm's length principle found in the Article 9 of the OECD Model Tax Convention. So this principle, I think, it's familiar to many of you, ensures that related party transactions are priced accurately, so based on market conditions. And so this is the arm's length principle, as everyone is quite familiar about, and that is included in Luxembourg tax law in the Article 56 of the Luxembourg income tax law. So the proposition of the directive, it's a good thing, because the OECD actually, the transfer pricing guidelines, it's the international standard, internationally speaking, and especially for OECD member states. Most of the OECD member states have already implemented the same or similar definition. And since most of the EU member states are already members of the OECD, except for 5 of them, which are Bulgaria, Croatia, Cyprus, Malta, and Romania, we can consider that this standard is already implemented. And so aside from these countries, the question remains, does the directive improve or innovate in any significant way? We'll see a bit later that, yes, this is the case. So when we speak about the OECD transfer pricing guidelines, the first question that arises perhaps is, which version of the OECD transfer pricing guidelines has to be applied in case of a dispute on the transaction? They are periodically updated, and so in Luxembourg, we always had, we were always of the opinion that given that under Luxembourg tax law, there should be no retroactivity of fiscal measures. It's hardly defendable in front of our constitution. It's always the transfer pricing version that was applicable at the time of the transaction that should be applied. But this is our approach in Luxembourg, but not the one adopted by the European Commission, which adopts a more dynamic approach and which basically says that it's always the latest version of the OECD transfer pricing guidelines that prevails. So that draft directive also will have to endorse the new version of the transfer pricing guidelines. So you will see that in the text of the directive, pretty much is taken from the OECD guidelines, and there are many similarities between the two. And the difference is that but there are still some differences with the provisions that we apply in Luxembourg. So the main point of focus of the directive are the following points. So the arm's length principle, of course, and what is the definition of associated enterprises? So the concept, what we have in the definition, the current definition of the Article 9 of the OECD Model Tax Convention is that it's a 50% test when assessing the association and the ownership based on this definition. And we see that now that the directive would lower that threshold to 25%, causing a much wider number of in-scope transactions. So Alain will detail this just later. Then we have the provision for transfer pricing adjustments, both corresponding and compensating adjustments. What are the reliable transfer pricing methods to be used? And then also one point that is quite important and that will differ from what we have at the moment in Luxembourg is the arm's length range of acceptable results. We see that the directive imposes a stricter approach to the arm's length range to the one foreseen by the OECD in their guidelines. So Alain will now explain all these different points. Thank you.
Yes, so we looked into the draft directive with a very critical view, keeping in mind that it's always the European Commission that tries to enter into TP matters by a backdoor. It used to be state aid. Now they try to do it via a directive, which at least is legally the best way to do it and the most legitimate. And the question we asked ourselves was, how would the Count Luxembourg transfer pricing regulations be impacted by this directive if the directive would pass as such? And as you know, Luxembourg is an OECD member, of course, and it has also implemented the OECD guidance on transfer pricing. We have the arm's length principle that is enshrined in Article 56 of our income tax law. The methodologies, the guidance is given by Article 56 bis. And we have another provision that is also usually linked with transfer pricing, which is Article 164.3 of the income tax law, and which deals with hidden profit distributions. Any non-arm's length advantage that is given by a company to a related entity can be requalified by the tax authorities as a hidden distribution of profits, which has the nasty consequence that it's not deductible and it's potentially subject to 15% withholding tax. And the last provision we have is the paragraph 171.3 of our general tax law, which basically says that upon request of the Luxembourg tax authorities, the taxpayers must provide the appropriate transfer pricing documentation to justify the pricing of their intra-group transactions. So keeping this in mind, let's see what the main points of the draft directive would change in Luxembourg. The first point that's interesting to analyze is, as Alexandre said, is the definition of the associated enterprises. In Article 56 of our income tax law, the legislator has basically copied Article 9 of the OECD Model Tax Convention that enshrines the arm's length principle. But apart from that, there is no further guidance under Luxembourg tax law. Pursuant to the directive, however, there are very specific criteria that are applied in order to define whether a company or an undertaking is related or not. And so the four criteria are listed here. So it's when a company or an enterprise participates in the management of another person, and by management they understand that if the person is able to influence significantly the other person. It's the control meaning that they are owning at least 25% of the voting rights, so they control the entity, they can influence it and decide take the decisions basically, or impose decisions. Then the next one, they are all alternative, so it's not cumulative. The next one would be if it's ownership rights. So again, if they own at least 25% of the company, then again, will be related entity. And the last one is the profit entitlement. So if it has a profit entitlement of 25% or more, it would be related entity. And this last element is the most curious one, because if a company is entitled to get 25% of the profits of the other company, I mean, you're not, where's the affiliation? If you would have a profit participating loan agreement, which as such is a debt instrument, but this would entitle you to get 25% of the profits, then you would be related entity. Or in another in another example, if you would have a third-party bank loan, it has a fixed interest of 8%, but this is more than 25% of the profits of the company. Well, then are they then related persons? So really quite curious and very far-reaching criteria, and I think they have not yet imagined all the constellation in which this definition could be applicable. So in the Luxembourg domestic tax law, however, we have none of this. We have basically related person. We have the usual OECD management and control test, and we have one further thing, which is in Article 164.3, and that is the notion of an interested person, which comes from the German tax law, nahestehende Person, and that means that any advantage that is given to someone who is very close to the company and who has somehow directly or indirectly an interest in that company can be requalified as a hidden profit distribution. And this was, of course, meant to give the tax authorities a lot of flexibility, especially in abusive situations, which go beyond the current OECD definition. So in our view, the definition of the directive is very strict. There will be a number of transactions that would not fall into the domestic definition that could be covered, especially with the 25% threshold in profit entitlements. But apart from that, Luxembourg domestic tax law has anyway a very, very broad definition, and so even the interested persons are covered. So the impact might be still limited, we hope. The next point is the corresponding adjustments, which basically is the situation if a first state proceeds to an adjustment of a price in a transaction to another affiliated in another country, which is called the primary adjustment. Well, then the question is, how does the other country react? And typically one would expect that this country should then do what we call a secondary adjustment. That means adjusting to the same requalification in the first country. So if you have, for example, in state A an interest payment to state B, and the tax authorities of state A, they consider that the interest was too high, and they would say, well, the arm's length interest would not be 100, but it would, for example, be 80. They would do downwards adjustment of 20, and only 20 would be deductible. Well, if 20 are only deductible in state A, state B, the taxpayer would say, okay, in fact, I received too much interest, and there has been on the group level a correction in state A, so you have to recognize here as well this correction, and you have also to do downwards adjustment, which is the second year adjustment, and only tax me on the 20 that are deductible in the first jurisdiction. So this is the whole issue of the corresponding adjustment that is addressed by the OECD as well in the TP guidelines. And the main rule is that the second state is only obliged to do a secondary adjustment if it agrees and if it accepts that the primary adjustment was arm's length. And that, of course, is the whole problem, because the state B is never inclined to recognize this, because if he recognizes this, he basically gives away his share of taxation to the first country. And that's where the whole debates and the whole disputes arise in practice, and where lengthy mutual agreement procedures have to be initiated in order to find a solution. But very, very often, actually, the cases remain unsolved and are ending in a double taxation. So there, the European Commission said, we need to change something, we need to improve this. So this has been included, the principle of the corresponding adjustment has been included in the directive, but again, under the same rule as under the OECD transfer pricing guidelines, that State B is only obliged to do a secondary adjustment if it's convinced that the primary adjustment was indeed arm's length. So we are back to square one, exactly in the same situation as before. The only good thing is that there's a fast-track procedure which basically obliges the tax authorities to rule on the admissibility of any requests in this respect for corresponding adjustment within 40 days. So they must just basically check if all the formal conditions are fulfilled, and if they are not, well, they have 40 days to say no, or they have to accept it within the 40 days. But then they have 300 days to rule on the acceptance of whether or not they would grant a secondary adjustment. But without this fast-track procedure, for example, in Luxembourg, usually whether you get a unilateral or corresponding adjustment in Luxembourg, you could count the day from when you start the procedure. Between 2 and 3 months, you will have the response, and 300 days so is in practice not really an improvement. The compensating adjustment is still a different problem. Compensating adjustments are adjustments that are done not by the tax authorities, by the taxpayer. For example, for one reason or another within an intra-group transaction, you were not able to set the price at an arm's length price. For example, you could not charge interest on a loan to another company in another jurisdiction because maybe there's a huge issue if to charge interest because it's already in a loss situation and so on. The interest would then, from a Luxembourg lender perspective, be deemed not to be arm's length. So what you then typically would do is you would maybe in your tax return, you would simply account for an imputed interest. So a deemed interest, an arm's length interest income. And that is more or less current practice in Luxembourg because we have Article 40 in the income tax law that says if tax law does not provide otherwise, the accounting rules are followed. So from an accounting side, you look at your supporting documents, you have an interest-free loan, there's no interest, you would have no interest income. But from a tax perspective, you have Article 56, which is the arm's length principle and which says all your pricings must be arm's length. So there you have a derogative provision that says you have to rectify your accounting in the tax returns and you have to account for an arm's length interest. Now, so compensating adjustments are quite common in Luxembourg. The draft directive says, yes, we understand the principle, you can do that, but you can only do it within certain restrictive conditions. So the directive emphasizes the criteria, which are the compensating adjustment must be well justified. Why are you doing this? This must be unexpected. Well, this is normally not the case if the CFO has done his work well. It must be consistently applied over time. It must be consistently applied by all member states that are involved, for all member states that are involved. So you could not just do a compensating adjustment in one state but not in the other. And it has to be finalized before the filing of the tax return. Well, given that it's in the tax return, that's normal. And in Luxembourg, actually, this would, at least in our view, be mandatory. So there again, compensating adjustment, do we need to change the Luxembourg domestic law to be in line with the transfer pricing directive? Most likely, at least for cross-border transactions, because there could be a case where under domestic law you would be obliged to do this adjustment, but under the directive you would not allow it to do it. So it's very nice for the taxpayer, of course. On the methodologies, in Luxembourg we apply the typical methodologies that are provided by the OECD TPG, and it's exactly the same in the directive. Also, you could use other methods if none of the OECD methods are well justified in your case. Again, exactly the same as that we have for the time being. So, as regards to methodologies, we couldn't find any improvement at all. On the arm's length range, and Alexandre has mentioned the point before, that's also interesting because we follow the OECD transfer pricing guidelines in Luxembourg, and this has been confirmed in a quite well-known landmark case law, which we had the pleasure in our firm to deal with, and which basically says that you could use any point in your range when you do the transfer pricing analysis and you end up with a certain range for an interest rate. The interest rate could be between, and you can use any point within that range unless there are any concern or any specific circumstances which would make you not to use any point but a certain point. So the principle is you can use any point unless the tax authorities have any reasons or any good arguments to make you use another one. So the directive is different. The directive says that typically you should only use a point within the lower and the higher quartile, so between the 25th and the 75th percentile, and not the outbounds, which you see here on the chart pretty well. And if the tax authorities challenge you, and if they see that your rate, for example, is within the interquartile range, they should not be allowed to make any adjustment. And if the result would be that you're out of bounds, basically, then they should take the median. So there's a big difference with Luxembourg domestic law, with OECD guidelines, Luxembourg case law. Whether this is very helpful, not sure about that. In terms of documentation, the directive focuses on the documentation. It says that it's very important. There are huge discrepancies between the member states and so on. But it doesn't say anything more specific. It basically postpones the discussion to another point. It refers to the master file, local file, CBCR, and so on, but there's nothing really tangible. So in Luxembourg, the rule is quite easy. You have to do your report in an OECD compliant way, which is described in Article 56 bis, and which is described in much more detail in the OECD transfer pricing guidelines. So, not sure if here any improvement will be made. Also, one point that's very important here is that Luxembourg courts have also confirmed that you could provide your transfer pricing documentation as soon as late in the process as you are before court in litigation with the tax authorities. There is no obligation as such to keep your analysis in the drawer to prepare it upfront for the case that the tax authorities would require it. Of course, in practice, this is hard to manage, given that if the tax authorities ask you are obliged to deliver it, but are you sure, if you haven't done anything in the past, that you will be able to justify your pricing? So therefore, in practice, at least the analysis, the economic analysis is always done in advance. So what are the pros and cons? The pros definitely are the OECD standard is endorsed, and hopefully the Commission has moved away from this strange idea of having a different arm's length principle from the OECD standard, a European one that could be used and abused by the tax authorities in a much more flexible way. The harmonization effort is definitely also a good thing, but on the cons, and that's also the question that several member states raised, what's the improvement as to the current situation? The rules could be stricter. They would still not be applied in the same way in the various member states. What about the third countries that are not EU? You could end up in a situation where you then have 3 layers of regulations. For example, in Luxembourg, we apply also TP rules for purely Luxembourg domestic cases. So for the Luxembourg domestic cases, you would have Luxembourg law. For the cross-border cases within the EU, you would have the text of the directive. And then for transactions with third countries, you would again use the Luxembourg and the OECD rules. So that's quite a mess. Are there any changes in domestic law that are necessary? Most likely, yes. If the directive would be endorsed. And last but not least, of course, the Commission has reserved its right that it could also unilaterally impose some other standalone concepts, which is always, for a lawyer, is always difficult and to understand. And it's always, we sense a lot of danger by, by doing that. So where do we stand? On 14th, I think it was 14th of June, the ECOFIN Council met, and basically the directive is nowhere. Most of the member states have, for one of these reasons, expressed their concerns, and for the time being there's a standstill, and I think the conclusion is that the directive will not as such be implemented. They would still need to further discuss and so on, but the political will to legislate in this is definitely there. So that were the conclusive remarks. So if you have any questions, please feel free. Thank you.
Thank you very much. So do you have any question for Alexandre or Alain? Maybe a first remark. So if I understand well, you say that this directive could be postponed. We have a new commission that is coming, so that could be again postponed. So I also got your point, so not really clear if it's improvement or not. But still, you mentioned in your last example, so problem for some companies, some are among our member, just Luxembourg activities. It's not a reason because it's just Luxembourg not to have a transfer pricing policy and principle applied. But then you can have relationship with other EU countries and of course international group, and we have many international companies having third-party countries, so that could be, how could you harmonize your strategy? Because for a big group and for treasury operations, it's better to have the same principle applied across the group. So I guess the more stringent ones to make sure that you at least satisfy the most or the stricter, let's say, inland revenues. Is it the policy applied, or they just try to apply depending on because applying different principles should be quite complicated?
I think exactly this point is one of the fierce critics of the directive, and most of the member states have criticized this because it would add another layer of regulation, and multinational groups still would have to apply the OECD rules. So it's not working in. We can only have a directive basically that is fully compliant with the OECD standards. Otherwise it wouldn't work. And so the entry into force of the directive is indeed, from a practical perspective, postponed, and they need further rounds of discussion to amend the text and to render it fully compliant with the OECD standards. Otherwise, it would not be viable.
So we have two levels of difficulties. So first, the text and the regulation is evolving, and it's not necessarily clear. And the second thing, the control are also evolving. I don't know, Alexandre, if you can comment, but what about the controls? We have the impression that we have more and more controls. Is it true? Is it the same in the different countries, or some countries are stricter, faster? And what about the expertise of the controllers?
We see that now the Luxembourg tax authorities, they have bolstered that team that are quite used to the transfer pricing specificities. And so, yes, I think that we see more and more litigation cases. Now, it's really important for taxpayers to really document their intragroup transactions. It's not like a few years ago where maybe they were starting with some questions, but not maybe with the level of expertise to really go in.
Today.
Yes, now they can. They have specific divisions that have been created for this kind of audits, and so it's something. I think it's one of the preferred angles for the tax authorities now to challenge it, because it's quite easy for them, because the burden of the proof is on the taxpayers. It's up to the taxpayers to prove that their controlled transactions are based on market conditions. And so this makes it very easy for the tax authorities to challenge.
But so it's a double challenge. So increasing of expertise and of the controllers, dedicated teams, and on the other side, so uncertain rules that try to be, let's say, clearer and clearer, new guidance, but still. And what you said is scaring, that potentially you need in some countries to apply a posteriori or retroactively the rules decided or interpretation of today for the past operation of the, I don't know, last 3-5 years, what is completely crazy. So better to be conservative and to be on the safe side and to be quite strict in terms of documentation, no?
Yeah, in this respect also, a specificity of Luxembourg was that transfer pricing is still relatively young, if you look at all the regulations. The first circular letter was only introduced in 2011, and I think it was really applied in 2012. The arm's length principle was enshrined in 2015 because before we had a very old Article 56 that was an heritage from the old German income tax law, which only applied to cross-border situations and where the tax authorities or somebody from the direction of the tax authorities could reassess the profit based on a rule of thumb. So it's quite something new, and you have a lot of companies and taxpayers that did not have any whatsoever TP documentation in place because the tax authorities never asked for it, and there was never a challenge, there was never a question. And so over time, of course, the tax authorities saw that this was an extremely easy angle to attack because so many taxpayers do not even have any TP documentation. So for them, it's very, very easy to challenge then the pricing on the transactions as they wish. And obviously this has encouraged the tax authorities also to take this angle of attack at the first place when they challenge something. What we've noticed is that as soon as you provide a robust tax TP documentation, they very often change their argumentation and they go on other more tax technical stuff to challenge transactions.
No, you clearly mentioned that. So a lot of our members are just waiting for the control. The same with me and some others. When you have not been controlled, you have the impression that it's not for you. But when you are controlled, you have a limited number of days to comply and to deliver the documentation. And retroactively, it's 3 or 4 or 5 years. I don't know exactly. It's 5 years.
No, I think they have the retroactivity is 5 years as such, but you have also to count the year where the tax has been generated, so actually it's 6 years. Okay. And the issue is that if you have a transfer pricing issue, they could do, of course, the primary adjustment by raising your taxable profit, but then given that the profit is not there, they can do a secondary adjustment, which is basically that they say the profit has been distributed, so you are in a hidden profit distribution, and then your prescription, the statute of limitation is increased to 10 years.
So better to be prepared. So thanks a lot for this comment. I think it was really interesting. And if you have any question, Alain and Alexandre will be around to answer your question. Thanks a lot.